February was marked by a return of volatility and a strong sell-off on equity markets after all-time highs in late January. Furthermore, commodity prices, including the oil price, also fell. While equities have since rebounded, interest rate-sensitive sectors such as real estate were the most severely affected. The correction has increased volatility strongly. After hitting a low of 9 last year, it has now stabilized at around 20. In this context of high volatility on equity markets, bonds did not play their safe haven role. The yield on nominal 10 years US Treasury bonds rose close to the 3% threshold, while the real yield reached its highest level since December 2015. The US employment figure was the factor that triggered this correction. Annual wage growth was up 2.9% in January, the best pace since 2009. Following the publication of this figure, markets anticipated a likely return of inflation and a tightening of the Fed's monetary policy. Indeed, the US economic stimulus plan, the weakness of the dollar and the tax reform at a time when the US economy is close to full employment suggest that inflation could well be back, confirming the probability of an increase in the Fed's key interest rates. In addition, fears about an increase in the budget deficit at a time when the Fed is gradually reducing its bond purchases could put pressure on long-term interest rates. To conclude, the return of volatility marks a regime shift in markets. In the coming weeks, we'll be carefully monitoring the probability of a return of inflation linked to an improvement in economic growth, American protectionist measures, and also any change in the Fed's monetary policy stance under the new chair, Jerome Powell. Thank you and see you next month.